Hello, everyone. Welcome to the Connect and Grow Real Estate Meetup. My name is Vivek Arza, and I'll be your host for today. Thank you all for joining us. Today's presentation is part of a series related to multifamily investing. The focus of today's presentation is how to select your target market. We'll go over various aspects that you will want to consider when selecting a market, how to access information to select, and finally, some tips and advice on how to do it. This presentation is filled with several pieces of information and demonstrations. Feel free to pause, take a break, and go over the demonstrations if you want a second look. So without further ado, let's get started. The plan for today will be to go over these three topics. Firstly, we'll want to take a look at what quantitative information sources there are all over the internet for free, which you can leverage to decide the market for your multifamily investing. Second, consider markets where you have an edge. What that means is what we'll get into one slide after the information sources. This is critical because a lot of us get caught in analysis paralysis and spend too much time analyzing and too less time investing. Finally, we'll round off with some tips and advice from my experience and several others who have been on this path before. The first section will cover some of the quantitative information sources as to where to access this for free all over the internet. Quantitative metric number 1, population growth since 2000. Population growth is a significant factor when it comes to choosing the market for your multifamily investing journey. Why the year 2000? Because it represents about 20 to 23 years of data, depending on the accuracy and the updation of the information source. You want to be investing in cities or metros that have significant population growth and consistent population growth since the year 2000. The source for this information is Google. You just want to type the city of your choice space population, and it gives you a nice graph all the way from 2000 to the current day. Let's not do the demonstration right away, but I'll do a full-blown demonstration right after this slide, so bear with me. The reference metrics that you want to look into or consider are these. Let's start from the bottom up. So for cities who are 200K population or less, you want to see that they grew at a 15% rate or more. For cities which are 500,000 people or more, which is 500K, you want to make sure that they grew at least 10% or more. And for large cities of more than 1 million people, you want to make sure that those cities are growing at least 5% a year since 2000. Now, why these specific metrics? The reason is very simple. It's because smaller cities do tend to grow faster than larger metros. Larger metros are more stable and add population, but the overall relative growth of population is less from a percentage standpoint. That's the reason you have different metrics for different city sizes. Finally, pay attention to loss in population during recessions. A city that loses population during recessions is not a good place to invest, because if people are running away from such a city during recessions in significant number, you want to see what the reasons behind that for is to begin with, and consider if you want to invest there. So this is how to find out the population growth of a particular city in the US. Just type Columbus, Ohio population, which is a city, state, and population, and this should give you a nice graph of how the population's been trending. Here, if you see the blue graph, it's showing a nice transition all the way from the year 2000, when Columbus's population was about 715,000 people, to 2021, which is 906,000 people. So take these two values and see if it is exceeding 10%, and that means Columbus is a city which is growing very steadily and should pass your filter. One good thing is it also shows some of the other cities within the same state or sometimes the same location. If it's on a border, it might show a different state. Look at Cincinnati and look at Cleveland. Both of these have been losing population over the years, Cleveland more so than Cincinnati. So these are places where you may still find opportunities, but you have to be really careful into investing in these markets precisely because of population loss. There's a city, 440,000 people in the year 2000, and now it's increased to over 500,000 people. St. Louis, on the other hand, has been steadily declining in population. So that's something that you want to keep in mind when you select your cities or markets. One example, again, just to conclude, I would like to show you is Detroit population. Not to pick on Detroit, but look at this. It was at about 945,000 people in the year 2000, and currently it has about one third of that, about 600,000 people. And what happens during recessions? The population of Detroit in 2009 was 800,000 people. It just dropped like a rock to 711,000 people. That's when Detroit became bankrupt. The city had to really sell properties and raise property taxes and all those things. So you definitely want to keep an eye on these kind of things. Again, not saying don't invest in Detroit, but be aware of what's going on at a macro level in the economy. Quantitative metric number 2, job growth and employment. The source for this is Department of Numbers, which is a government website, and BLS, which is the Bureau of Labor Statistics, again a government website. It's surprising to realize that all this information is available on the internet for absolutely no cost. As it explains, job growth and employment play a significant reason as to which market to consider while investing. The more number of jobs means more income, and the more income means more demand for rentals and rental properties. Employment is a significant indicator of the strength of the economy, which is why we rely on these two metrics. Some of the reference metrics that you want to consider while looking at job growth and employment, you want to see a consistent growth for a city's job growth since 2000, barring any recession periods, which obviously there is job loss during recessions, so we understand that there could be some dips during recessions. Also, you want to see at least 2% annual growth in job growth annually. The reason being that indicates at least the jobs are growing at a very decent pace. The third and the most important aspect here is the diversity in job sectors need to be in fields which are recession resilient. What I mean by this is there are certain sectors within the jobs which are more recession resistant or resilient compared to others. For example, professional and business services, which are high paying professional jobs, do not usually tend to go away during recessions, barring a tech recession, of course, but these are very stable jobs. Similarly, education and health services, hospitals tend to do very well during recessions. Similarly, the education and college towns. Trade, transportation, and utilities. These are your backbone economy, which is all your trade, shipping, transportation, utilities like water, sewer, everything. They do not just switch off during recessions. These are very stable jobs. Finally, government and financial sectors also tend to show very strong job holding capacity during recessions, which is why we like these four sectors when we look into markets as to where to invest. Finally, the unemployment percentage should be no more than 2% than the US rate. What I mean by that is if you're looking in a metro, the metro's unemployment rate should not be more than 2% of the US rate. Let's say the current US unemployment rate is 4%. If you're looking at a market, you want to stay below 6% unemployment rate, or else something is going wrong with that specific metro compared to the US economy. Moving on to job growth, this is a wonderful website that very few people are aware of. It's called the departmentofnumbers.com. It's a government website which essentially lists the city, state, the number of jobs added in the latest month. Although I'm recording this in May, it only has February data. These ones are not so important compared to the last 1 year of jobs added. And the most important column here is how much percentage of job growth was there in the last 1 year. Again, if I just reload this page, I will get this data pretty much unsorted. And I'll show you how to sort this data and make sense of this. So you see here, you get a city state in pretty much a random order. You want to click on this column and sort so that you see the highest job growth cities on top, and then you scroll down and go to the lowest. Now, I do want to take a couple of examples here to walk you through what a good market looks like and what a bad market looks like. Now, right off the bat, you may be tempted to think Midland, Texas is one of the most incredible markets to invest in. Let's take a step back and understand what Midland, Texas is. Midland, Texas is in the Permian Basin of West Texas, which is an oil or a fracking region. And you may be tempted to say, hey, it's grown by almost 9% in job growth in the last 1 year. But click on this, and it'll take you to what the historical graph looks like. This is where you want to go to. Total employment for Midland, Texas. Ignore the CES and CPS. Those are more technical terms, which I won't cover here. That's not the scope of this discussion. So look at these graphs. Now, we all know 2009 to 2011-12 was a deep recession, so almost all places in the US lost jobs. So this blip is okay. But look at Midland, Texas. It went chugging along fine till 2015, and then there was a big drop in jobs, meaning a job loss, a year or two. Similarly, it went up, and in 2020, it lost incredible number of jobs. Sure, there was a recession, pandemic, COVID related. But what happened in 2015 was when oil started crashing in its price. Now, you do not want to be exposed to something which is whose employment is so dependent on oil prices that one fluctuation in oil prices can result in significant job loss. Similarly, there's another market, which is, let me go back to the same sorting order. There's another market called Odessa, Texas, which shows you the same story. 2009, loss of jobs. 2015, loss of jobs. 2020, another massive loss of jobs. Again, Odessa, if you see, is heavily dependent on the oil market. An example of a market that you want to consider, and again, this is just an example I just picked randomly. Look at Jacksonville, Florida. If I go to Jacksonville, Florida, it's grown by over 4.7% over the last 1 year. And if you see the graph here, look at the steady growth. Even in 2007, there was not a massive loss of jobs. Still, yes, there is a massive loss, but it's much more smoother. And look at this consistent growth since then. Pandemic took away a lot of jobs, but even after that, it's been growing well. So you want to see a very smooth growth and rise, and not hit too many inexplicable sort of dips in the job growth from 2009 to 2021. Hope that helps you understand a little more deeper. Now, going back to the table itself, this is a good way to kind of understand how the market is doing. And the metric is you want to have at least 2 to 3% growth over the last 12 months. The second part about jobs is what is related to unemployment or other employment. This again is a free website, again a government website, but the BLS, or the US Bureau of Labor Statistics. This page is called bls.gov/EAG. You want to get to this page and then select any place in this market which shows you how the employment status is for any metro. Let's pick Kansas as an example here. If you click on Kansas, you want to go to the very top, which shows you the most important cities in Kansas. Of course, you have Kansas City. Let's dig deeper. When you click on Kansas City, you see something like Kansas City Area Economic Summary. It's a PDF file, so let's click on this. Let's zoom out for a little bit. Now, this is an amazing snapshot of what's happening in the Kansas City area. So Kansas City area, if you see the unemployment rate, it's much less compared to the United States overall. And so United States unemployment has gone from 3.8 last March to 3.6 this March, record low unemployment. Look at Kansas City, it's at 2.8. Within Kansas City, look at these counties. Johnson County, Wyandotte County, Clay County, and Jackson County. So you get a county by county assessment of what's going on. You also understand what the wage profile for these counties are. So the more brown, the more wages or the higher rents they are, higher incomes eventually. The lesser brown, which is the yellow and the creamish color, they are lesser household incomes. Again, very generic terms, but gives you a good idea. One more table that you want to look into is this table right here. This in a snapshot tells you what are the major industries that Kansas City has for employment. Look at this. The majority are in trade, transportation, and utilities. A stable sector because of all the warehousing, e-commerce, transportation, and utility sector here. The second biggest sector here is professional and business services. Again, a very resilient sector during recessions. The third would be education and health services. Goes without saying, it's a very resilient sector. And the fourth is the government. The government, yes, does have budget cuts and everything, but the government is very slow to cut jobs and very easy to add jobs. So this is one more resilient industry in Kansas City. This should give you a very good overview of a city's economy, unemployment, and how the jobs are divided based on different sectors. You should know more than the people staying in the city if you look at this one page. That's how powerful this website is. So please pay attention to this and then use it in your research. Quantitative metric number 3, median household income and home values. The source for this information is city data. This is another absolute treasure trove of information, which has several of the previous metrics also, including median household income and home values. We'll get into a demo in just a bit, but let's see what we want to look for here. The reference metrics you want to look for is a median household income of $50,000 or higher. Why $50,000? Because it represents a good amount of income to be able to support healthy rent levels. Generally, when you go 50K or lower in terms of household median income, you tend to see higher crime, lower payment rates, and a rougher tenant base compared to the other side of the coin. I would highly recommend you stay in areas or locations which are 50K or higher in median household income. You also want to see growth in home values. Now, why does this matter to someone who's renting out a property? Because you want to see that there is demand for houses where you are investing. You do not want to generally be in markets where there has been no growth in home values since 2000. The 75% growth since 2000 represents roughly a 3% compounded annual growth rate for about 20 years since 2000. That means if a home was valued $100,000 in 2000, that metro's home value currently should be $175,000 or higher. One of my favorite websites on the internet is called citydata.com. Again, a free website. You don't have to pay anything. I will caveat this by saying the data on this website is about 1 to 2 years old, so you're not getting the latest information. But like I say, cities generally don't change in 1 to 2 years. It takes about 5, 10, 15 years for the city's population and everything to change very drastically. So type up any city that you like. Let's take the example of Kansas City because we've been on that. Kansas City, Missouri. It gives you an overview. It gives you some pictures if you'd like to see what the city looks like. The things that I'm looking for in this website are population. It says since 2000, the population's increased about 12.2%. Mind you, this population is only till 2019. So this is a little bit outdated. Again, everything is till 2019. So take that, keep that in mind. Median household income, this is what we want to see grow from 2000 to 2019, $55,000 to $59, higher than what our threshold is. It was $37 and $200. So good amount of growth there. Similarly, I want to see home values grow in the last 19, 20 years. It was 83,300 in 2000. Now it's 168,400, almost a doubling in value. And I want to see at least 75% increase from 2000 to 2019. So that easily passes the test. One more demo that I want to do in citydata.com is by clicking on this thing called Kansas City Income, Earnings, and Wages Data. Click on this and I'll walk you through what this looks like. It says click here. So when you click on this, you see make sure it's selecting median household income and most recent value. Again, this data is about 2 to 3 years old, but still gives you a very good idea of what things look like. The more purple or dark the blocks within this picture are, means that area has a much higher income level. So if you zoom in, you see areas like, because I'm familiar with the metro, I would take you to something like an Overland Park, which is a very wealthy area. Let's click on something very grayish. Let's see what the income level is. If you see here, it says census block group, some number, median household income, $83,000. If you click on show more, look at this data. It says how many people live in this particular block, how many households there are, what is the racial profile, if that interests you, what's the median household value, what's the median home income, what's the unemployment. Now, unemployment, I have not seen this to be very accurate because I don't believe Overland Park has a 7.4% unemployment. So these four categories, I would take this with a grain of salt and rely on your local sources for that value. But income and condo house value have been relatively accurate. I would say median house value is also maybe lagging a little bit. So take that with a grain of salt. Now, one more thing that you could use this is, you see how you have median household income here? And then you can select either the most recent value or change since 2K. What 2K here is the year 2000. So percentage change since 2000. That is very important because you want to see what the fastest growing areas are. Now zoom out a little bit, go down, click here. Look at all the dark areas. All these dark areas have grown significantly high since the year 2000. Similarly, you can also hover into cost of living, family income, and many different types of information. But this gives you a very good idea of the income level right now and also the change since the year 2000. Hope this helps you, and you should use this in your research because it's essentially a block by block information about income and the change in income, most importantly. Quantitative metric number 4, rent growth and affordability. Rent growth is absolutely important when you consider markets to invest in. Not only do you want to see home values increase, but you also want to see rent growing at a steady cap. While rent is growing, you also want to make sure that the tenants or the prospective tenants are able to afford these rents, which is why affordability becomes critical. The source for these sets of information are Yardi Matrix and Real Page Analytics. Both of these are paid services, and I will not be doing a demo for Yardi Matrix, but I'll show you what the Real Page Analytics homepage looks like, and there are several pieces of valuable information you can extract from that. One bonus point you want to consider, which is pretty self-explanatory, you want to be in states which are business and landlord friendly. I won't go into too much depth here. This is readily available for free on the internet. These are generally states in the southwest of the United States, the southeast of the United States, and the Midwest markets. These are generally landlord friendly, business friendly, and tax friendly. I'd like to end this slide with a demo of the Real Page Analytics website and the information that you can get from there for absolutely nothing. Now let's take a quick demo about Real Page Analytics. This is a paid service. They have property management, a lot of data analytics for rental properties, etc. But their homepage consists of a blog, which you will get access to if you click Analytics. go to analytics blog. Just scrolling here, you can see how many articles are here for free. Again, don't expect very deep level data, but let's click on one of these articles just to see what's happening here. After ranking US apartment occupancy by geographic region, let's click on this and see what's happening. This is a very recent article, May 19th. And if you see, it shows you how each of these areas is trending. The South, the Midwest, the Northeast, and the West. Understanding of what's happening here. Believe it or not, all of this is free. And yes, you don't have a very deep understanding of each market, but sometimes, every now and then, you get articles like this. Nashville apartment supply hits a 3-decade peak. Look at this. I already covered this, or I'm going to cover this in a Yardi matrix graph, but Nashville is seeing huge amount of supply. Now look at the demand versus supply. The demand is growing low, but the supply is outpacing demand, which means Nashville is likely going to see some rent declines soon, if not already. So keep that in mind, and when you make decisions. But the idea here is the real page analytics data or analytics blog is extremely useful in getting real time data. That's pretty much what I had to share here. And back to the slides again. Now that we have looked at some of the metrics that we want to consider while choosing a market, here are a few slides from Yardi Matrix, which we subscribe to, that are demonstrating the rent growth for the first quarter of 2023. This recording is as of May 2023, and the data is a couple of months old, which is understandable because it takes a few months to trickle in. Let's look at some of the markets which have seen the highest year-over-year rent growth in the United States as of 2023 March. Leading the pack is Indianapolis, which absolutely is crushing it when it comes to rent growth. It's about 7 to 8% annually. So March 2022 rents compared to March 2023 rents, they have grown about 7 to 8%. The second market I'm excited about, because we have several investments there, is Kansas City. This city continues to show resilience and growth during the tough times of the economic uncertainty. And we have been getting this information right from the ground and also seeing this on our existing properties. New York, Boston, and Chicago, the major cities, have been seeing healthy rent growths as well. Miami is one of the cities in Florida which is doing really well, although Miami has some other problems of increased home asset price values. Philly, LA, and Portland, those are generally cities which are not very landlord friendly. So although they are on this list, I would recommend looking deeper into those markets. Charlotte, Orlando, Nashville, these are the southeast markets, or the south market, which is Orlando. These have been showing some good growth as well. Finally, the national US rent growth number for 2023, one year over year, is 3.2%, which is in line with historical growth rate. I'd also like to share this slide from Yardi Matrix again, which has a much more detailed understanding of each metro. You not only see the year-over-year rent growth, but you also see the forecast rent growth for next year. The next column is the job growth, which is important because the more number of jobs get added, the more incomes get increased, and the more rent grows. Finally, I want to draw your attention to the last column, which is completions as a percentage of total stock. Now, a market might have the highest rent growth and the highest income growth and the population growth. But if there is a lot of supply coming onto the market in terms of new builds, then that could cause competition in the future, which means your rent growths could stall. A couple of metros that I'd like to point out here are Miami, Nashville, and Twin Cities, which is Minneapolis. These markets are seeing significant addition to their new stock, which means another 6 to 18 months, you'll see significantly higher number of competition come in, which means your rent growth could stall if other things keep the same pace. Again, just to keep something an eye on. The markets that we are in, Kansas City, is seeing not as high completions of total stock number. Look at Indianapolis, it's just 0.5%, meaning nobody's building there despite seeing 7% rent growth from last year. Such are the markets that you want to be in, where rent growth is high but completions are low, which means the competition for your property is going to go through the roof. One last component that I want to draw your attention to is the rent to income ratio. As of March 2023, there are some metros which are hitting limits of rent to income ratio which cross affordability standards. It's not enough if you have high rent growth, but if your tenants cannot afford those going forward, then it doesn't serve your purpose. So you want to keep a very close eye on these metrics as well. Again, the source of this information is Yardi Matrix. Let's look at one of the least affordable rental markets according to Yardi Matrix. Sacramento, the typical renters have to pay 40 to 41% of their income as rent. Usually the ballpark is 1/3. Anything over 1/3 is slightly unaffordable. Anything less than that is very affordable. The suspected markets, New York, Washington, D.C., Orange County, LA, all those are very expensive markets which are at the top of the list. So the way to read this list is go from the bottom up. And unsurprisingly, you see Midwest markets dominate the affordability sector. Kansas City is one of the most affordable cities as far as the renters are concerned. Kansas City, typical renters spend less than quarter of their population on rents, which is incredibly affordable. Indianapolis is 26.2. Some of the southern markets are also very affordable. And as you transition to the left side, you have some of the more expensive markets like Portland, San Francisco, LA take the lead, where even though jobs pay more in income, the rents are relatively much higher than some of the markets which are more affordable. Since we've looked at all the quantitative metrics of how to select a market, here is a slide which describes some of the more actionable steps you can take. Identify markets where you have an edge and take action. Let's see what these edge factors are when it comes to market selection. Firstly, identify markets where you have potential partners or real connections. Now, let me elaborate on this. This is extremely important because you can start making offers, you can start looking at properties much quicker if you already have potential partners or real connections in that market. Your barrier to entry is lowered, which means you can start making progress much quicker. Now, I said real connections. It doesn't mean that you had a friend from college long ago who was remotely not interested in real estate. That is not a metro that you have a real connection in. A real connection is someone who will work with you or at least help you figure things out in that market very quickly and make sure that you can move faster. Potential partners are either people who have invested in that market or are wanting to continue to invest in that market and are consistently looking at properties in that metro. That is where your barrier to entry is a lot lower. Secondly, pockets within states which are growing rapidly. Remember, you invest in a city, not the entire state. Real estate is very hyperlocal through some of the demos that we just looked at. Some of the states which are called flyover states, when you fly through the nation, you just don't realize that they have growth engines within them. For example, Columbus and Kansas City are markets which are located in states which are not very high flying, but Columbus and Kansas City are economic growth engines by themselves. Columbus is located in Ohio. Ohio is not a very high flying market, but people from Cleveland and Cincinnati are flooding into Columbus, and there are several investments coming into the metro. Similarly, Kansas City is in the state of Missouri and Kansas on the border. Kansas as a whole is a steady Eddie growing state. Missouri, on the other hand, has cities like St. Louis, which are absolutely losing population. But Kansas City seems to be the jewel of the state of Missouri, which is the economic powerhouse. So identify those markets which people are not paying attention to, where you will have less competition and score much better deals. Finally, Local information and knowledge advantage is unparalleled. What does this local information look like? Maybe you know of a new development that's coming up that not a lot of people are privy to. Maybe you see outsized demand for rentals in a market that not a lot of people are paying attention. I'll give you an example of both of these happening to one of the properties that we just recently closed on. A property in Overland Park, Kansas that we recently closed had a new development come up right opposite it that not a lot of people knew, but because of the connections in the market, we knew that that was going to come in 2 years' time, which is 2025 onwards. That will boost our property's value because we will present a much more affordable product to the product coming right next door. Another such example for the same property was we were seeing outsized demand for two-bedroom units in the location that we were looking at, meaning two-bedroom units were on a wait list, and as a renter, you could not get a two-bedroom unit for at least 2 to 3 months out. This was happening at the tail end of last year and the beginning of this year, which made us pull the plug on the deal and go forward with it. And we are enjoying the fruits of it right now. Now, this information is very specific to one property that we closed on, but we look for nuggets of information like these, which are not very easily attainable by just going over the internet. So leverage those sources, leverage that information. I'd like to leave you with some final thoughts, tips and advice that I would give myself about 3 to 4 years ago when I was just starting in multifamily. The first thing is network with others to learn about potential markets. And in conjunction with this presentation, it's easy when you split markets and do research by many people and share your knowledge and information than doing all by yourself. You learn a lot more, you get a different perspective, etc., etc. I would encourage whoever's interested to form a learning group and share your learning very openly. And all of these sources are free, so you're not losing anything by sharing. And my policy is you never lose anything by sharing. The best way, again, to learn is by teaching others. You learn 10 times more than what you've taught. Next, if you are considering hot markets like Texas, Arizona, and Florida, be very sincere to yourself that competition is going to be extremely tough. Be patient, be ready to accept rejection because a lot of folks are looking for properties in these markets, which means property prices get driven way high. In these markets, I would almost enforce that you want to have at least one person on your team who is either local and experienced in that market that you're investing in. That's the only way you will get quality access to deal flow. Finally, focus your efforts into one metro and stay consistent with that one metro until you've built a team. From my experience, it takes a good 3 to 6, if not 9 months of serious work to understand the market dynamics and establish a solid team on the ground. Both of these are very important for you to have success. Dig deep into a market instead of spreading yourself thin across many markets and not getting anywhere. Finally, I would leave you with this. It is much better to do a decent deal in a secondary or a tertiary market than a bad deal in a hot market. A hot market will not save you from a bad deal, but a decent deal in a secondary or a tertiary will do really well. I encourage you to send me any questions you should have. Hope you enjoyed this presentation, and we'll see you in the next one. Thank you.